Welcome to Future Funds for Kids, Beyond the College Question. In this video, we will explore how parents can invest for a child's future when the path ahead is uncertain. College, trade school, or entrepreneurship. We'll compare key account types, clarify what the modern 529 plan can really do, and lay out an action plan to balance growth, flexibility, financial aid impact, and control. Let's begin. In this agenda, we will start with the core dilemma and why market exposure is important. Next, we will debunk myths about the modern 529 plan and show its expanded flexibility. Then we will cover why a parental brokerage account can offer maximum flexibility and control. After that, we will warn about the pitfalls of custodial accounts. We will finish with an actionable plan, visual diagrams, and quick quizzes to reinforce your understanding. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Rules can vary by state and may change over time. Please consult a qualified professional who understands your specific situation before making decisions. Now, with that in place, let's move forward. Parents often face uncertainty about a child's future path: college, trade school, or entrepreneurship. Despite this uncertainty, growth is still necessary, and a standard savings account will not keep pace with inflation and long time horizons. Therefore, market exposure becomes essential. Additionally, it's short-sighted to assume a child will not need any post-secondary training. Income gaps continue to widen, making some form of advanced education or training increasingly important. With that context, let's examine why market exposure matters. Market exposure matters because compounding grows most effectively over long horizons when invested in assets like broad market index funds rather than low-yield savings accounts. Inflation reduces the purchasing power of idle cash, whereas diversified equity exposure has historically outpaced inflation over long periods. Choosing the right account type can materially improve after-tax outcomes. By aligning the investment vehicle with your goals, you can preserve flexibility without giving up growth. Now that we understand the need for exposure, let's tackle the modern 529 plan and what it can truly do. The modern 529 plan is far broader than many assume. It covers not only four-year universities, but also trade schools, certificate programs, apprenticeships, and even some K-12 tuition within defined limits. The key advantage is tax-free growth when used for qualified education expenses. If the beneficiary does not use the funds for education, recent law changes allow up to $35,000 to be rolled over to the beneficiary's Roth IRA, subject to constraints. The 529 must have been open at least 15 years. Amounts contributed in the last 5 years and their earnings are ineligible for rollover, and the rollover counts toward annual IRA contribution limits. Non-qualified withdrawals are taxable and may incur penalties on earnings, but the benefits of compounding inside a tax-advantaged account often still make the 529 compelling. Now let's contrast this with the parental taxable brokerage for maximum flexibility. On the left, the 529 plan offers tax-free growth for qualified education expenses, supports a range of programs including trade and apprenticeship options, allows some K-12 use, and includes the ability to roll up to $35,000 into the beneficiary's Roth IRA under specific conditions. The trade-off is that non-qualified withdrawals are taxed and may be penalized on earnings, reflecting an education-centered design. For financial aid, 529s are typically treated as parental assets, which is generally more favorable than student-owned assets. On the right, a parental taxable brokerage account provides maximum flexibility for any expense, including living costs or starting a business, and the parent retains total control. The downside is ongoing taxation of dividends and capital gains, and the absence of special education tax advantages. For aid, these accounts are also treated as parental assets, which usually has a limited impact compared to custodial accounts. Next, let's quantify differences across account types in a concise table. This table compares 3 account types across primary use, tax treatment, control, financial aid impact, and special perks. The 529 plan is education-focused, with tax-free treatment for qualified expenses and potential Roth IRA rollover benefits. Parental brokerage accounts are fully flexible but taxable. Custodial accounts are also taxable and shift control to the child at the age of majority, with a higher financial aid assessment rate because assets are in the student's name. With that overview, let's highlight why custodial accounts can be problematic. Custodial accounts transfer control to the child at the age of majority, typically 18 or 21, regardless of whether the child is ready to manage the funds. Additionally, student-owned assets are assessed at a higher rate in need-based financial aid calculations, potentially reducing eligibility. If you want market exposure and ongoing control with less impact on aid, a parental brokerage account is often a better fit. However, custodial accounts can still be appropriate when the intent is to make irrevocable gifts to the child, with an understanding of the consequences. Next, let's outline an action plan you can implement. Begin by prioritizing your own retirement and maximizing any employer match, as this is foundational. Decide if you want a dedicated education bucket. If so, open a low-cost 529 plan and invest in broadly diversified index funds appropriate for your timeline and risk tolerance. If you need maximum flexibility for non-education goals, complement the 529 with a parental taxable brokerage account. Automate contributions and schedule annual rebalancing. Review beneficiary designations, investment options, and any state-specific 529 tax benefits each year. Finally, plan for financial aid by minimizing student-owned assets and holding significant savings in parental accounts when possible. Now, let's solidify your understanding with a quick quiz. Question: which of the following are valid uses or features of a modern 529 plan? Options: A. Only 4-year college tuition. B. Trade schools, apprenticeships, and some K-12 tuition. C. Unlimited cash withdrawals with no taxes or penalties. D. Guaranteed Roth IRA rollover of any amount at any time. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Modern 529 plans cover trade schools, apprenticeships, and some K-12 tuition, in addition to traditional college costs. Options A, C, and D are incorrect because 529s are not limited to 4-year institutions, do not permit unlimited tax and penalty-free cash withdrawals for non-qualified uses, and do not allow unlimited Roth rollovers. Rollovers are capped and subject to rules. The 529 to Roth IRA rollover has a lifetime cap of up to $35,000 per beneficiary. The 529 account must have been open for at least 15 years before rollovers are permitted. Contributions made within the last 5 years and the earnings on those contributions are not eligible for rollover. The rollover is also constrained by the annual IRA contribution limit, and the beneficiary must have earned income in the rollover year. These rules are important to plan for well in advance. Next, to visualize funding priorities, let's look at a pie chart. This example pie chart allocates 60% to parental retirement accounts, 25% to a 529 plan, and 15% to a parental taxable brokerage. The rationale is to secure retirement first, because underfunded retirement can become a burden on the family. Then, target education tax advantages through the 529, and maintain a flexible pool in a parental account for non-education needs. Now let's lay out a timeline of milestones that can affect your choices. This timeline highlights key milestones. During K-12 years, 529s may allow up to a $10,000 annual withdrawal for tuition, depending on rules. Around age 18, financial aid filings occur, and custodial account transfers may be imminent. Between 18 and 21, depending on the state, UGMA or UTMA control shifts to the child. Once a 529 has been open for at least 15 years, rollovers to a Roth IRA may be possible, subject to the rules we discussed. Early career years are crucial for earned income, enabling IRA contributions and counting toward rollover limits. Annually, you should rebalance investments and review any state-specific 529 benefits. With these milestones mapped, let's check your understanding with another quiz. Question: which account type typically has the greatest negative impact on need-based financial aid calculations? Options: A. 529 plan held by parent. B. Parental taxable brokerage. C. Custodial UGMA or UTMA in the child's name. D. None of the above. Impact is identical. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Student-owned assets, like those in custodial UGMA or UTMA accounts, are typically assessed at a higher rate in need-based financial aid calculations than parental assets, such as a 529 owned by the parent or a parental taxable brokerage. This higher assessment can reduce aid eligibility. Now, to wrap up, let's crystallize the key takeaways. Key takeaways. Prioritize retirement first, then fund children's goals. Modern 529s offer broad eligibility and potential Roth rollovers under defined rules. For maximum flexibility and control, use a parental taxable brokerage. Avoid custodial accounts unless you deliberately want the child to own funds at the age of majority. For financial aid, it is generally better to keep assets in parental accounts. Automate contributions, rebalance annually, and review rules each year. Before we close, one more visual to reinforce the decision path. This decision flowchart begins with your primary objective. If tax-advantaged education growth is important, the path points to a 529 plan, with notes on qualified expenses and the Roth rollover rules. If you need flexibility for any purpose, or you want to complement a 529, the parental taxable brokerage is the next branch, emphasizing control and taxation. If your intention is to gift assets irrevocably to your child, and you accept the consequences, the UGMA or UTMA branch applies, with a reminder about control at age 18 or 21 and the higher financial aid assessment. The chart also annotates FAFSA impacts, highlighting that parental assets are generally treated more favorably than student assets. Now, let's conclude. In summary, secure your retirement first, then add dedicated education savings and a flexible parental brokerage as needed. Leverage a 529 for tax-free education growth and the potential Roth rollover under the applicable rules. Maintain a parental brokerage for non-education expenses to keep control and flexibility. Be cautious with custodial accounts due to control transfer and financial aid implications. Review annually and adjust as life and rules change. Finally, let's close with a thank you and a quick call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. Tell us in the comments how you're planning to balance 529s and taxable accounts, or what questions you still have. Your perspective helps the whole community learn.